Here's the second quarter 2026 Cornerstone market update. We're going to go through three factors in this video: the political landscape, the lessons learned from the tariffs, and macroeconomic trends. Let's start by reiterating what we stated in the quarter one market update. At the start of this administration, President Trump emphasized a focus on Main Street, not Wall Street. Many initially interpreted this to mean that he would prioritize middle-class economic well-being even at the expense of market performance. Yet, experience has shown that the president is unwilling to let prolonged market weakness persist. For example, he initially pressed forward with aggressive tariffs but paused quickly once equity and credit markets began to falter. This pattern is consistent. While his methods are often controversial, his actions demonstrate a willingness to support the markets when needed. For example, think of the Doge dividend, where he was going to pay a certain amount of money to each citizen based on the savings that through Doge. Also, he did a lot of tax cuts through the OBBB and was giving out a lot of money. These things are all to help boost the stock market. Trump's given no indication that his commitment to Wall Street has changed. The other major factor that we want to talk about is Trump's new Fed chair pick. Typically, markets don't like uncertainty, which could be a bearish sign. However, if investors interpret this as an attempt by Trump to stimulate the stock market, sentiment could quickly turn bullish. This dynamic warrants close attention. A dovish Fed chair could signal lower rates ahead, while a hawkish pick might dampen near-term enthusiasm. So keep an eye out for that. The second point we want to talk about is the lessons learned from the tariffs. Now, April of 2025 was declared by President Trump to be Liberation Day, when he initiated sweeping tariffs across the board on other countries. This geopolitical shock sent the markets sinking, dropping double digits from their peak. On April 8th, he reversed course, causing the markets to regain 10% in a single day. From that point on, the markets continued upward, ending the year up 17%. Those who missed that single day of performance, where the markets went up 10%, struggled to achieve double-digit gains for the year when the S&P was up 17%. The lesson learned from those tariffs is that technical analysis does not trump Trump. What we mean by that is that people were not predominantly relying on fundamentals or technicals. The markets were relying on Trump's words. And in today's environment, we're approaching a similar moment as we were during the tariff episodes. Markets could continue down, but if our first conclusion is right, that Trump is focused on Wall Street, then he will do all he can to support the markets. Further, the tariff episode showed us just how much sway he truly has over the markets. This means Trump is both able and probably willing to tactically change course to temporarily hold up the markets. Now, the third point is macroeconomic trends. In our last edition, we discussed that large players in the stock market have fundamentally changed the way they view gold and silver and its place in a portfolio. Here's what we stated, quote, "These changing perspectives were on full display when Morgan Stanley's CEO recommended shifting from a traditional portfolio with 60% in stocks and 40% in fixed income, switching to a portfolio with 60% in stocks, 20% in fixed income, and 20% in precious metals. As large players and influential people recommend putting money in gold and silver, it will become a sort of self-fulfilling prophecy, continuing the appreciation of these assets. Presently, both gold and silver have had notable pullbacks during the Operation Epic Fury, the war in Iran. However, we see no indication that major players have reversed course concerning precious metals. Nothing goes up forever, and thus it could be seen as a healthy correction rather than a change in sentiment. Additionally, further de-dollarization in the East could prove very bullish for gold and silver. In conclusion, we don't fully know what's going to come in the second quarter of 2026. But due to the above factors, we think the best option is to maintain the current allocation. Our models currently maintain a diversified approach, which has helped us on the downside, but should allow us to take part in any sudden upward movement. Give us a call for more information.